All right, let's get started. This is your executive intelligence briefing for February 10th, 2026. Okay, here's what's on the agenda today. We're going to start with the new macro anchor. Then we have two deep dives, one on infrastructure capital and another on the credit constraint. After that, we'll touch on a key undercurrent, AI compute industrialization, and then we'll wrap it all up with the executive summary. All right, let's dive right in. The single most important development you need to have on your radar right now is the new India-US trade deal. It's the new anchor for macro sentiment. So what's the key? The golden thread here, the one number that really unlocks this whole story, is 18%. That's the new reciprocal tariff, and it's a huge drop from the previous 25%. Okay, so let's break down what's actually in this deal. That 18% tariff cut? It's anchored by a huge commitment from India to buy $500 billion in U.S. goods over the next 5 years. To put that in perspective, the baseline was just $45 billion, so a massive jump. But, and this is critical, the deal has some important exclusions. We're talking key agricultural items like dairy, soy meal, and lentils are carved out. Now, you have to understand the context here. This deal didn't just happen in a vacuum. It's landing in a market that's been bleeding capital. We're talking about $34 billion in equity outflows just since last October. That's the biggest outflow of any emerging market. And why does that matter so much? Because U.S. investors hold about 41% of those FPI assets. So their sentiment is absolutely key. You can see the market breathing a sigh of relief in the immediate reaction. The rupee jumped 1.36%. So what are the first reactions on the ground? Well, here's a crucial reality check from Akshat Garg. His point is really simple. Look, markets can get a temporary boost from good policy news, but that's not what sustains a rally. At the end of the day, it all comes down to earnings. They have to deliver. And that brings us to the execution risk. Ashwin Patil hits the nail on the head here. He's flagging the fine print, especially around agriculture. If they get the management of these quotas and exemptions wrong, well, it could cause a huge disruption in a really critical part of the Indian economy. Now, on the other hand, you've got a more optimistic take. VK Vijayakumar is connecting the dots for us. He sees this deal as the catalyst that brings foreign investors back, especially with the help of a stronger rupee. But listen closely to the timing here. All of this optimism hinges on seeing clear signs of an earnings recovery in fiscal 27. It's not a sure thing just yet. Okay, so here's the bottom line on this. This deal is a big deal because it compresses policy risk. It basically opens the door again for foreign capital to flow in. But, and it's a big but, its success is not guaranteed. The story now shifts. We're moving from policy to execution. And there are two things you absolutely have to watch. Can companies deliver on earnings? And how will they manage the risk hidden in that agricultural fine print? All right, let's move on. Our second deep dive is all about the appetite for large-scale infrastructure capital. And the hard number driving this story? $2 billion. That's the potential price tag for a major portfolio of road assets that's on the market right now. So what are we talking about here? The portfolio is Macquarie's Safeway concessions. And this isn't some pie-in-the-sky project. We're talking about 9 mature, fully operational toll roads. It's a massive network, 681 kilometers, that already serves 38 million commuters every single year. So the bottom line here is crystal clear. A $2 billion price tag for this kind of asset tells you one thing. There is a deep and sustained pool of institutional capital out there. And it's not chasing high-risk ventures. It is laser-focused on large, operational assets that spin off predictable cash flow year after year. Okay, for our third deep dive, we're shifting gears. We're going from large-scale capital down to a critical bottleneck in the real economy. And we're going to look at it through a very specific case study. And the signal here is this quote. It gets right to the heart of the matter. The core problem limiting growth in a huge supply chain, it isn't a lack of demand and it isn't a lack of processing power. The real constraint is upstream. It's the limited ability of small farmers to actually expand production. The Misty Milk case is a perfect example. Here you have a company doing over 2,500 crore in turnover. They source from about 2,000 farmers. But here's the kicker, the real insights. They could integrate 70,000 more farmers into their network right now, without any major new capital spending. The bottleneck isn't the factory, it's the farm. So the bottom line here is this. If you want to know what's holding back the scaling of entire supply chains, it's credit, specifically the credit constraints facing small producers. Growth is being choked off, not because there isn't demand, but because there isn't enough financing at the very beginning of the chain. All right, let's turn to the key undercurrent we're tracking. This is about the industrialization of AI compute. We're talking about a massive physical build-out. And the data here is, well, it's pretty stark. Look at these numbers. By next year, AI workloads are set to eat up 23% of all data center capacity. Fast forward to 2030, and that's projected to hit 50%, half. What that means is we have to nearly double global capacity from 103 gigawatts to 200 gigawatts in just 5 years. That is an incredible pace. And here's the bottom line on AI. The race for dominance isn't just about who has the smartest algorithms anymore. It's now a physical, industrial scale challenge. This insane growth is completely reshaping everything: CapEx cycles, the supply chains for advanced chips, and the war for specialized talent. Okay, let's pull all of this together now in the executive summary. So, 4 key takeaways for you. First, the trade deal is done, policy risk is down. The focus now shifts entirely to earnings delivery. Second, there's a wall of capital ready to deploy into large, operational infrastructure. Third, if you want to unlock growth in supply chains, you have to solve the credit problem upstream. And finally, the AI race is no longer a software race. It's an industrial infrastructure building race. So we'll leave you with one question to take back to your teams. We're seeing a clear shift away from navigating macro uncertainty and toward driving micro-level execution. The question is your capital allocation framework actually ready for that shift? Are you prepared for what comes next?